Hey everyone. In this video, we'll walk you through trading chart patterns like an expert. You'll see exactly how we implement these strategies when trading stocks and crypto. There are countless trading patterns, but we'll focus on the ones that work best. These are the most effective and frequently occurring patterns in the market. Let's dive straight in, beginning with the first one, the double top and double bottom pattern. Here's where we break down each pattern's structure. First, price moves in an uptrend before hitting two equal highs. These peaks create a resistance zone, while the low between them forms the neckline. So, what does the double top indicate in terms of price action? It signals that buyers lost momentum, failing to push the price higher. This loss of strength from buyers suggests a potential reversal. Now let's look at the opposite scenario. Price trends downward before forming two matching lows. These lows create a support zone, while the high between them becomes the neckline. So, what does the double bottom pattern reveal? It shows that sellers failed to push the price lower, signaling a momentum shift. This loss of selling pressure suggests a possible trend reversal. This brings us to the next big question. How can we integrate the double top and double bottom into a trading strategy? Also, drop a comment below with topics you'd like us to cover next. We always use your feedback to decide on future content. There are four primary ways to trade these patterns. Let's start with the first, the neckline break entry. When a double top forms, the neckline is set at the recent swing low. Once price breaks below this level, making a lower low, it confirms a trend reversal. That's when you take a short position to ride the new downtrend. For a double bottom, the neckline forms at the recent swing high. Once price breaks above it and reaches a higher high, the trend change is confirmed. At that point, you take a long position to capitalize on the uptrend. Now, let's move to the second method, trading a double top or bottom when it aligns with a key price level. This setup appeared on Ethereum. First, you identify a key level where price has reversed multiple times. As price revisits this level, a double bottom forms at support. To confirm the reversal, place the neckline at the swing high. When price breaks above the neckline, it signals an uptrend shift. This is your entry point for a long trade on lower time frames. Another confirmation method is to use a trend line connecting swing highs. Once price breaks above the trend line, that's another sign of reversal. Now, let's see how this works in a downtrend. First, identify a key resistance level based on past price reversals. As price revisits this area, a double top pattern forms. To confirm the pattern, place the neckline at the swing low. When price breaks below the neckline, making a lower low, the downtrend is confirmed. That's when you'd enter a short position on lower time frames. This example also highlights multiple trade entry opportunities. Some traders enter short immediately at resistance. Others wait for confirmation from the neckline break. Pattern traders typically wait for the double top to complete before entering. All these approaches are valid. Your choice depends on your trading style. So, what makes a double top or bottom at a key level so powerful? It increases trade quality because multiple traders are watching that level. Pattern traders and support resistance traders both enter, creating strong momentum. Now, let's explore the third approach. Instead of entering on the breakout, waiting for a pullback entry. Returning to the Ethereum example, we see a double bottom with a neckline break. Instead of entering right away, traders could wait for a retest of the new support. This level had been established previously, making it a high probability entry. One crucial aspect is stop loss placement, which varies based on entry type. A breakout trade requires a different stop loss strategy than a pullback trade. Now on to the fourth approach, using candlestick formations at key levels before a double top or bottom forms. First, identify a key level based on past reversals. As price reaches this level again, look for candlestick reactions. A long wick candle signals a reaction, but that alone isn't enough for a trade. Price could still break through, so we need further confirmation. This is where lower time frames help refine entries. Switching to a lower time frame reveals more price movement details. On the daily chart, price action might seem choppy, but on a 6-hour chart, clear swing points become visible. In this case, a double top formed precisely at resistance. The neckline is placed at the swing low, confirming the trend change. When price breaks below the neckline, the reversal is confirmed. That's when traders look for short entries on lower timeframes. Now let's flip this scenario for a downtrend. If price was trending downward, the same logic would apply in reverse. If you'd like to support us, don't forget to hit the like button. Make sure to subscribe and turn on notifications so you never miss an update.